Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. Speak about the mutual fund space, and invariably, anybody that you speak to will talk about one category of mutual funds in the equity space, and that is the sectoral and thematic category. And the reason why is pretty obvious if you think about it. In any given year, the top performing fund is usually a sectoral or thematic fund. And the reason for that is that these are concentrated investments in one particular sector, and in any given year, there will be one sector that beats the rest. The point is that past returns often govern how people invest in the future as well, and that's the reason why people have gravitated to this space. At this moment, at the end of August, you had as many as 226 sectoral and thematic schemes with a total assets under management of over 5 lakh crore rupees. That's the largest subcategory in the actively managed equity mutual fund category. Now, that should tell you something. It's even more than flexi cap funds, which had at the end of August assets under management of 4.95 lakh crore rupees. Today, I'd like to talk about which sectors generally tend to do well, what the seasonality element is over the course of the last 10 years, and how you should adjust your strategy, if at all. Rushabh Desai, founder of Rupee With Rishabh Investment Services, is joining me today. Rushabh, thanks so much for taking the time as always. You've done a little bit of research on the way that these sectors have performed over the last 15 years, in fact, on a 5-year daily rolling basis. What has that data shown you?
Hi, Alex. First of all, thanks so much for having me on the show. As you correctly mentioned, that a lot of clients and investors are gravitated towards sectorial funds mainly because of the lucrative returns what the sectorial and thematic category had to offer over the past 3 to 5 years. Over the past 3 to 5 years, the returns have been quite phenomenal, anywhere between say like 25 to 35% CAGR basis. I'm not talking about absolute. This is on a CAGR basis. So when you talk about CAGR returns, it's compounding on an annualized basis. So 25 to 35% is quite substantial amount of returns what we saw over the past 3 to 5 years. Now, usually sectorial funds or sectors tend to be cyclical and volatile. Now, over the past 15 years, I pulled out some very interesting data on a 5-year daily rolling basis. Now, I wanted to find out, Alex, that which all sectors have performed consistently, which all sectors have performed in a much more cyclical way, and which all sectors have been volatile. Okay, so I took out data of top 15 sectors. Namely the auto sector, banking sector, commodities, energy, financial services, FMCG, pharma, manufacturing, tourism, infrastructure, IT, media, realty, service sector, and transportation and logistics. So these are the 15 sectors, what I looked at, and the data has come out quite interesting. Number one is that, there are 4 buckets I can put these sectors in. Some sectors have performed consistently on a 5-year daily rolling basis. Some sectors have performed consistently but have been volatile at the same time. Some sectors have been purely cyclical, and some sectors have been cyclical plus volatile. Now, let me go through each of this bucket. So, banking sector, financial services sector, FMCG sector, IT sector and services sector fall under the consistent bracket. Now, why I say consistent is that, see, these 5 sectors have generated greater than equal to 12% CAGR returns 70% of the time period. So 70% of this entire 15 years on a 5-year daily rolling basis, banking, financial services, FMCG, IT and services have generated more than 12% compounding returns. This is number one. Number two, these sectors have generated no 0% or no negative returns on a 5-year daily rolling basis. Number three, now these sectors have displayed lower standard deviation which is low, which means lower volatility, with an average return anywhere between 13 to 17%. Now, if I combine all of these five sectors, the average return stands at 15% compounding returns. So these are the reasons why I feel, based on this data, these sectors come under the consistent sectors category.
Before we move to the second category, I do want to ask, because these are ultimately the sectors that have the most weightage in several indices as well. Because if you look at BFSI itself, you're talking about, for the Nifty 50, over 30-35%, right? You're talking about FMCG also has a pretty substantial weight, and IT as well. So BFSI and IT together would be more than 50% of the index, one would hazard a guess to say, right? So is that also something that is having a bearing? Because if you think about it, these flows into these companies are also on account of the weightage that they have in the broader indices, right?
I absolutely agree with you, Alex. See, banking and many financial services companies are more or less large cap companies, or even if mid cap, they fall under the little bit of on the higher market capitalization within the mid cap space. Okay, so if you see today the mid cap, you can also consider, see, even mid cap goes into a few thousands of crores of rupees, right? The market capitalization. So I feel even if you take out the mutual fund, the flexi cap, multi cap, focus, these kind of mutual funds, maximum mutual funds do have large allocation towards banking and financial services. See, the reason why mutual fund industry is comfortable investing such large allocation towards banking, financial services, FMCG, IT, right, is because these sectors have proven to be comparatively more consistent than the average. And when we talk about returns, see, ultimately in the end, mutual fund industry wants to provide more consistent returns and to provide much more better returns experience to the retail investors out there. So I think this is the predominant reason why you see a lot of AMCs and fund managers tilting towards FMCG, IT, and banking and financial services.
Got it. The second category that you've pointed out based on your data is consistent but volatile. And that's interesting because for an investor, what they would experience is that they would have gotten the returns, but at the cost of a little worry in a situation where the scheme that they're investing in would have gone through both the dips as well as the fantastic returns, right?
Absolutely, Alex. So there are two sectors which fall under the consistent plus volatile basket. One is the auto sector and second is the transportation and logistics sector. Now the returns again have been quite phenomenal, Alex. These sectors, both of these sectors have generated greater than 12% compounding returns on a 5-year daily rolling basis, more than 70% of the entire 15-year data. Okay. Number two, now why volatile? Because these sectors have given negative returns. The negative returns have been around 5% of the entire time frame, which is 15-year. And if you see, the standard deviation has been little more on the higher side compared with the consistent sectors. Now, why I say it's consistent, because the average returns span anywhere between 16 to 17.5%. So with phenomenal returns, these sectors have also generated higher standard deviation. That is why they come under consistent plus volatile basket, Alex.
So in this case, you're talking about greater than or equal to 12% compounded annual growth rate. When you say higher standard deviation, do you have the measure of what that standard deviation stood at for, say, the automotive sector?
So the standard deviation for the auto sector stood at around 11%. At around 11, yeah. So that's again, I took out the standard deviation on a date of 5-year daily rolling returns, right? So what you see on the websites, on third-party websites, would be little different, and my standard deviation would be little different because the calculations have been little different. So see. The standard deviation has been in double digits. So if the standard deviation is in the single digit range, then it's considered to be comparatively less volatile. If the standard deviation comes, say, around 9.5, 10%, then it considered to be little more volatile than the average, Alex.
Yeah. So, but just to drive home that point, if you're talking about 12%, and a standard deviation of double digit, that effectively means that you've come very close to just about flat returns, and you can have had in that time frame a return of what, 20% plus as well, right? That's the definition of how standard deviation in this case would work.
Absolutely. The spike in the returns would be more on the upside and on the downside as well. So as you correctly mentioned, that, the returns can go like say 20-25% upside also. And at the same time, the returns can go 20-25% on the downside as well.
Got it. All right. Cyclical sectors is next, right? And these are pretty, at least one of them is pretty obvious. If you talk about commodities and generally you talk about metals in this basket, then there is cyclicality associated, because ultimately in India as well, we are price takers on whatever is happening globally. So if global steel prices or global aluminium prices or copper prices go up, then we see that happening here in India as well, and the stocks follow through. Is that how to read this?
That is one way of reading it, Alex. So there are three sectors which fall under the cyclical basket. One is the commodities basket, which you correctly and beautifully explained. Second is the energy sector, which is also globally linked. And third is the manufacturing sector. So manufacturing sector is directly and indirectly globally linked as well, because in the manufacturing space, we are dependent on number one, energy, and we are dependent on multiple commodities as well. So now when we say cyclical doesn't necessarily means huge spike in returns on the upside and on the downside. Cyclical means that these sectors may give you no returns, or maybe flattish, or maybe a little bit on the negative side for a longer period of time, say like 5 years, 6 years, 7 years at a stretch. Now the data has come out quite interesting, Alex. So unfortunately, these sectors have not been able to generate greater than equal to 12% compounded returns more than 60% of the time. Number two, these sectors have the returns of these sectors have hovered anywhere between 0% to 12%, more on the single digit side for a longer period of time, for greater number of time. And the average returns if you see of all of these sectors combined has been less than 12%. So to put it very simply, these sectors have generated single digit returns for a longer period of time, for greater number of times during this entire 15 years on a 5-year daily rolling basis, Alex. So these sectors will require precise entry and exit in order for investors to get optimum returns.
Yeah, and that's broadly the case for most sector thematic funds as well. There's one last bucket which you have had a classification of, and that is the cyclical and volatile sectors. What are they?
So cyclical, as I just mentioned, that the sectors will have prolonged periods of underperformance and flattish returns, and volatility means there will be intense spike in returns on the upside and on the downside. So now there are few sectors which fall under the cyclical plus volatile basket. One is the pharma sector. Second is the infrastructure sector. Third is the realty sector, which is real estate. Fourth is the media sector. And fifth is the tourism sector. Now the data shows that these sectors have generated negative zero and negative returns anywhere between 10 to 45% of the entire time frame of the entire 15 years. Okay. Number two, these sectors have generated again single digit returns higher number of time over the last 15 years on a 5-year daily rolling basis. And if you see, the average returns of these sectors has been anywhere between 2% to 13%. So now that's the exact reason why I feel that if the average returns are falling anywhere between 2% to 13%, it is very well suited that these sectors fall under the cyclicality and the volatility basket both together.
Got it. Okay, so what are the takeaways then? Ultimately, that is what we're speaking about today. If somebody does want to have a sectoral allocation, if they're talking for the very long term, if they're convinced, for example, that ultimately if the growth story of India is to go through, it is to be on the back of the banking and financial space, because you're ultimately not only talking about banks here, you're talking about broking companies, you're talking about capital market players, you're talking about insurance companies. It's a pretty wide ambit. So you can have a sectoral allocation. It's just that perhaps, Rushabh, you shouldn't have an oversized allocation of maybe 40-50% of your portfolio in any one sector. Is that the right interpretation?
Absolutely, Alex. See, number one, I usually don't recommend sectorial funds to my clients, and I really don't recommend taking sectorial bets. Is number one. Number two, if at all someone wants to take sectorial bets and sectorial allocation, that needs to be taken in their satellite portfolio, not in their core portfolio. Number three, at an overall portfolio level, if I combine the satellite and the core portfolio, the sectorial allocation should not cross more than 10%. This is what I feel. Number four, if someone wants to take sectorial bets, they should be taking sectorial bets out of their surplus money. Okay, that should be kind of their play around money. Now, the best way to take sectorial bets is to time it well, right? Now, there are three ways to time these kind of sectors well. Is when the sectors fall under price correction, number one, when the sectors fall under a time correction, number two, and when the sectors fall under valuation correction. So when you see a sector falling in price correction, time correction, and valuation correction, that is the right time to enter in that particular sector. And when the valuations and the price peak out of that sector, just get out and book your profits. That's as simple as it goes.
Yeah, exit is as important as entry when it comes to these sector funds, because ultimately they don't have room to hide when the sector as a whole is getting beaten down. Take any sector in the recent past. Just last week, for example, the information technology space saw the benchmark drop by as much as 7%, and this is because of the whole H1B issue and certain other news points that came through, not least of which was the Accenture results, which pointed to a bit of a question mark on the outlook for growth for the sector as a whole, and you saw quite a few large stocks see drops. So, but another question comes to mind. If you're not doing sector thematic, what should you be doing?
Alex, first of all, you need to understand that why are you going into sectorial and thematic category? See, typically investors go into sectorial and thematic category to get higher returns, okay, to get superior double-digit risk-adjusted returns, right? Now, I feel the best way of doing this is by entering in the mid and small cap funds and mid and small cap category as well. If you see the mid and small cap funds, mid and small cap category gave some fabulous returns, around 25 to 30% compounded returns over the past 3 to 5 years. So if someone is looking for superior double-digit risk-adjusted return, I think going in the mid and small cap space will actually solve their purpose.
Rushabh, thanks as always for taking the time for speaking to us. Very interesting data that you've shared, and I think this should give our viewers something to think about.
Thank you so much, Alex.